Good morning, everyone. I'd like to introduce myself. My name is Fred Pfister. I'm an attorney with White and Bright, and today's presentation is brought to you by the North San Diego County Realtors. This presentation is going to be recorded, and it's going to be on the residential purchase agreement. So without further ado, I'm going to share my screen so that you can see the presentation that we'll be talking about for the next 2 hours. I appreciate that all you are here on a bright and early on a Monday morning. And let's get right into it because this is my favorite form. Okay, hopefully everyone can see this. This is obviously um, the title screen here for the residential purchase agreement is what we're going to be talking about today. And there's my firm and my name. Obviously, this is the key form that we always talk about. You know, if you know one form, you need to know the residential purchase agreement. And so this will be what we go over today. Before I start, I just want to let you know that we're having some technical difficulties at my office. Obviously this is live, and every one of you who remembers what it was like during coronavirus times, you remember, in real time, it's not always great. But I apologize for any technical difficulties or any additional sound you might hear, or if any lights go out. They're actually doing work. It looks like our network is partially down here, so I apologize for that. The other issue I want to mention before we get into this is that this isn't that most interactive process. Obviously, I'm kind of talking into a screen, and you guys are listening passively, which is fine. But I certainly encourage you to follow up, whether it's in the chat, whether it's in the Q&A. I will try to get to those at the end. It's very difficult to do that in real time, but I think we'll have some time at the end. And even if we don't, you're always welcome to follow up with me. One thing I always try to do for my friends here in the real estate industry is to make myself available as much as I possibly can so that you have the information and you have the information to succeed in your business, because that's really what this is all about. It's succeeding in your business, and that's why you're here listening to this presentation. So as we get into this, the first thing I'm going to do is I'm going to do a shameless plug, right? Who am I and why are you listening to me on this Monday morning? Well, there's me with a little bit more hair. I'm a partner at White and Bright. I have a legal practice that focuses on civil litigation and real estate transactions. That's my bread and butter, is representing realtors, whether it's on the transactional side or whether it's in litigation and disputes. My litigation practice is in purchase and sale transactions and in your defense of agents and brokers, title issues, breach of lease, easement, you name it. If it's involved in real estate, I probably do it. I've been the general counsel for North San Diego County since 2016, and I've been working in this industry my entire career. So I certainly appreciate this is the best realtor organization in San Diego County. I don't say that lightly. And these are the type of work that I do. And so when I do this presentation, I'm going to come at it from a perspective of an attorney, not as a person who, an agent who actually fills out the form, but I'm going to talk to you about how you fill out this form and the points that I think are important, because I see these actually litigated. Just 3 weeks ago, I was in an arbitration litigating over a residential purchase agreement. So I do this in real time. This isn't theoretical, and I can tell you, practice points that I see that I think are important in these types of when you're filling out this form or when you're advising your client. What do you get sued on? How do you avoid lawsuits? How do you avoid issues? I mean, forget about the lawsuits. Just avoiding issues, I think, is really important, because that takes away from your business. So that's the type of work I do. I have a firm here at White and Bright. Many of you are familiar with White and Bright. It's been around for more than 40 years. And we do other types of disputes as well. Things like if you get a DRE accusation, we do corporate law, we do business transactions, we do estate planning and trust administration, trust litigation, and employment law. So if whatever your needs are, please reach out to us. Next thing is I throw up this disclaimer that I am not your attorney. The information I'm giving you here is for informational purposes. So I hope you all know that. So if I do have an attorney-client relationship with you, that's great. I'd love to have it. But for the purposes of today, this is informational. This isn't legal advice. Please know that. Okay, so what are we going to talk about today? Without further ado, um, we're going to obviously talk about the residential purchase agreement, the fundamental document in any real estate transaction. It's the by far the most important agreement. If you know one document, you know this one because everything works off of this. So we're going to talk about the major terms of the transaction, how to fill out the form, what is important. We're also going to talk about the RPA, what I call the RPA matrix. If you remember, I think it was 2021, they changed the form. They added a whole bunch of new pages and they made this matrix to put all the information in one section. And I think it really helped. And I've seen a lot less problems with filling out the form. There's certainly the same issues of what does this mean or what does that mean. But in terms of filling out the form and understanding the form, I think it's helped tremendously. And so we'll review what I call the RPA matrix in detail. We'll also talk about the addenda and advisories. What do those look like? The important ones, what we're going to look at there. The items included in sale. This, surprisingly, you see a lot of disputes over was this included or was that included. Yep, there go the lights. Like I said, we're in real time here, so the lights just went back on. We're talking about the items included in a sale and the items excluded, so that you're aware of what that is. We're going to talk about closing and possession. A lot of issues that I see there. Obviously, the seller disclosures, the fundamental part of any agreement is the seller disclosures, and then of course the contingencies and removal of contingencies. There's nothing like the removal of contingencies to gather disputes and to gather problems. And understanding those ahead of time helps you glide through a transaction. Then, of course, we're going to talk about the recent changes to the RPA. As many of you know, there's been certain changes to the RPA over the last couple months, and we're going to talk about those in detail so that you're aware of those new changes. And then I'm going to talk about dispute resolution, something that's, I think, poorly understood by a lot of agents and brokers is how to navigate the dispute resolution and when to call a lawyer, when not to call a lawyer, and just have that information in your back pocket, because if you haven't had a dispute, you will. I can almost guarantee it at some point in your career, whether it's this year, whether it's next year, whether it's 20 years from now, you will have a dispute, and knowing how to navigate that from the initial stages, I think is pretty important and something we're going to talk about today. Okay, so the way I'm going to work through this is I'm going to use screenshots, and we're going to take a look at essentially the RPA from screenshots of page by page, or I wouldn't say every single page, but we're going to hit the highlights, right? So what you're going to see here is kind of a sample transaction, and as some of you know, when you do a sample transaction, you have to put a property address. So what property address did I include? What am I selling today? Well, I'm selling my office. My office is located at 970 Canterbury Place in Escondido, so that's what we're selling today. Of course, I would be using the wrong form, right? So the first thing that we talked about here is my office is an office building, right? And so I'd be using the wrong form if I was using the residential purchase agreement. I should be using a commercial purchase agreement. So, step one is what agreement are you using? It sounds strange, it sounds very basic, and I apologize that some of what we're going to talk about here is basic, but I see all the time people using the wrong form. And it's mostly what I would call development property, where it is a piece of property, whether it's mixed use, or whether it's raw land, or it's some other development property, and they use a residential purchase form, and the issues just don't necessarily apply. I know that most of the people on this call today or this Zoom today do the residential purchase agreement, and they sell homes, whether it's a tract home in Carlsbad, whether it's something in San Diego and Hillcrest, whether it's a condo downtown. you're selling residential real estate. So that's really the form we're going to talk about. But make sure you have the right form, because right now I'd be in violation. Um, so you're going to see a lot of these as well. When I use these red arrows, and you'll see some green arrows. The red arrows are things I want to highlight today, and the green arrows that you'll see a little bit later are new items that have just come into this agreement. Because as you'll see, this is, as you see here, revised 624. What we're looking at today is the June release. So when it says 624, I hope you can see my cursor. If you can't, that's just look at the top there where it says CAR Form RPA revised 624. That denotes that this was revised as of June 24th. So it's very current. So the first item is the date prepared, as you see there. So I'm just going to cut a little bit of coffee this morning. The date prepared, that's typically the date we refer to this agreement as. Now, that date, it can essentially be somewhat of a random date, because it's not necessarily tied into any of the escrow or when this was signed, but it is often the date that you first opened and started typing things in here and prepared this document. For attorneys and for others, it's also the date we reference this document. So if I was going to reference this document at a later date in some type of writing or some type of court filing, I would call this the California Residential Purchase Agreement and Joint Escrow Instructions, dated, July 22nd, 2024, or whatever date that's in there. That's often the reference date. The next item is, of course, who's this offer from? And you'd be surprised how many times people put in the wrong name there, or they don't put the name that they intend to hold title, or they forget to include another party. But this is obviously where you include who is this offer from, because this document is almost always prepared by the buyer's agent, coming in and saying, I'm making an offer. And so making sure you have the correct buyer or buyers is important here, so that you're not having to change that at a later date. We'll talk about changing it. It's not the end of the world, but it seems silly to me that if you know that two people are buying a home and together, and then you only include one, or you include the wrong name, that can be easily cleaned up at the offer stage. Next item, what property are we buying? That it seems fairly simple that we would get that in there, but you often see if it's complicated, or if it doesn't have an address, that you'll see people mess that up a little bit. Obviously, in this case, we have my office building that we're selling here. The next item is the assessor parcel number. Now, remember, an assessor parcel number is a tax ID. Sometimes people reference the property by the assessor parcel number, especially when we're looking at raw land. Oftentimes, when I see raw land, or there's multiple parcels, that becomes much more important. But I'm glad it's in here, because it's something that you should be looking at, because you'll often see residential property with multiple parcels, and so you'll want to make sure that's in there. I highlight this because this was added, I think in 2021 when they added this, but I could be mistaken on that, which is the postal mailing address may be different from the city jurisdiction. I'll give you an example. There's a lot of Escondido addresses, right? Escondido is a large city here in North County, but there's a lot of it's surrounded by a lot of county land. And the county land often has an Escondido mailing address. And so people may be under the impression that, I'm buying something maybe up in Hidden Meadows, or something, even further north of there, that they might think, oh, that's in the city of Escondido. It has an Escondido address, but it's not. It's actually county land, which, as many of you know, makes a difference, right? It might make a difference for schooling. It might make a difference for, how you get a building permit, right? Do you have to go to the city, or do you have to go to the county? It's important to identify that and identify that with your client early in a transaction, that just because you see a mailing address that says Escondido or Vista or something like that, it doesn't, or even San Diego, it doesn't necessarily mean that it's in the city. It could be outside the city. Uh, and so that's a nice reminder, but it's also a nice reminder for you about something like that. Next item is, and this should be near and dear to your heart, which is the agency. Agency is obviously most important for agents and brokers. And this is item 2, right? Right after we identify what property we're going to have, we need to identify who are the agents and brokers that are going to be involved. And in this case, you'll see that you obviously have the seller's brokerage firm. That's where you put in the seller. So if you were going on the MLS and you saw who the seller was or the seller's brokerage, that's where you might include them on here. Obviously, since I filled out this form, it says White and Bright is the buyer's brokerage firm, which of course is incorrect, right? Because I'm not selling anything here. I'm obviously not selling my property. But you'll see that this is the way you fill it out. So you obviously fill out the seller's brokerage firm. You check, are they representing the seller, or are they going to be a dual agent? Who is the seller's agent? That goes next. That the agent and the brokerage likely are different, but are they going to represent both sides? That's obviously the checkbox that you would see at the bottom. And then the buyer's brokerage firm and the buyer's agent. Of course, if they're representing both sides, they're a dual agent, which has its own problems. I know a lot of you love being a dual agent, and a lot of brokerages love being a dual agent. But if you want to check out my red flags or my non-disclosure material facts or litigation dispute presentations, I talk extensively about the possible pitfalls of being a dual agent or having your brokerage be a dual agent in a transaction. But if you are going to be a dual agent, that's perfectly fine. That's the box that you would check. And then your name would actually be listed twice, is the way I see it. It's not just listed once down here. It would be listed as a seller's brokerage firm and the buyer's brokerage firm. And you would check these boxes in section 2B. Okay. So we're going to talk now about what the matrix, and this is my favorite part of the RPA, because I think it consolidated. It was revolutionary when it happened in 2021, but it really consolidated all the information that your client wants to see, or what I should say is the negotiation parts of the agreement, into one, very large and multi-page matrix that helps you fill out the form and not miss anything. Nevertheless, even though it made it so much easier, I still see on the problem transactions, I still see people miss information. I don't know whether they're filling out the form quickly or whether they're filling out the form with limited information. But I consistently see, especially in the problem transactions, remember, I get a lot of the problem transactions. I consistently see people filling out the form either incorrectly or partially. I would say that's even more common, where they just omit something. And then they're like trying to recreate the wheel once there's a dispute 15 days into the transaction, or worse, 45 days into the transaction. And they're going back and saying, oh, we forgot to include that. But let me tell you how this works. So, and I apologize for some of you who are pretty sophisticated on this, so because this will be fairly basic. So the way this works is that you have these columns, and for instance, so the way you would reference this is we're in section 3 and 3A. So 3A would be the purchase price, right? Because that's the title, and that is the defined term. Right? So the purchase price, it's defined because it's in bold. That means it's defined in the rest of the agreement as the purchase price. The paragraph that it's referenced. So, let me talk about this. So then you put in the term and condition, right? So this is what you fill in. This is the fillable field. So I could put in I'm going to buy, this office building, or I'm going to buy this residential home for $1 million. That's where you put it in. If you wanted more information about that $1 million and the purchase price, you reference what is column 2, which is the paragraph number. So this 3A references 5 and 5B, and then it says in parentheses cash. What does that mean? Well, that means if you click the button over here for all cash, if I'm making $1 million all cash offer, then I would want to look at 5B. But if I was just looking at the purchase price, if I wanted more information about the purchase price, I would look at paragraph 5. And that works for all of these as we go down. So for instance, if you wanted to look at 3C, the expiration of offer, and you wanted to look at the time, you filled out this information, the terms and conditions, and you wanted more information about an expiration of offer, which isn't much often in dispute, you would want to look at paragraph 33A. So that's the way this works. So I'll give you this one example, and then we'll go into all the terms. So again, we're looking at 3A, the purchase price. So this is what we would fill in. $1 million, $2 million. We're gonna add it in there. And then we could look at, we're looking at 5A, right? 5A it talks about the deposit, the increased deposit, retention of deposit. Oh, and here is that all cash offer. And I want to focus on this. So let's say I had gone back, I'll go back here, and I had checked all cash, right? And my client, the buyer, wants to know, what does that mean, right? Well, I go here. Well, I can read this. If I specified an all cash offer, what does that mean? Of course, it means there's no loan, right? It means there's no loan, and it's not contingent upon the buyer obtaining a loan. That's what I often see people, they want to make their offer look great. So they say, well, it's an all cash offer. And then they try to get a loan because, not a lot of people have $2 million in cash. Or if they do have $2 million in cash, they don't necessarily want to pay for $2 million in cash. And so they'll oftentimes try to source a loan after. The issue, of course, is you can't make that a contingency then. If you're making an all cash offer, you can't make it a contingency that you get a loan. But the way this works is that, okay, so remember we were in 3A, it referenced 5B, and then in 5B, it says, buyer shall within the time specified in paragraph 3H1 deliver a written verification of funds, right? So what that verification is funds, it says, well, I have the $1 million, here's my brokerage account, here's my bank account, here is, some reference that I have that verifying that I have the $1 million, the $2 million. What I want to focus on is paragraph 3H1. Because you're thinking, well, why is it referencing that? Well, if you go to 3H1, here it is. So remember I told you there's a big matrix? Well, that matrix for 3H1 is the verification of all cash. And the H part of it, it tells you when the time frame is. So these things all kind of work together. So you have 3A where you specify the amount. You then look at 5B where it talks about, okay, how long what do I have to do? Well, I have to verify that I have all cash. And how long do I have to do it? Well, it tells me in 3H1. And so the verification of my all cash and sufficient funds, it's either, remember, you have options here. It's either attached to the offer. So I would almost put my hands over that. If you have it attached to the offer, it's you have it, you're done. Or if you don't have it attached to the offer, you could say 3 days. You would check the box and do, okay, the default is 3 days after acceptance. So they accept, you have 3 days to provide them those verifications of funds. To make it even more fun here, you could specify. So if you want to get real creative here, you could say, well, I'm not going to attach it to the offer. I'm going to use the or. So I'm going to check the box, and then I'm going to say, well, I'll give it to you in 5 days, or I'll give it to you in 1 day, or whatever you want. But the way this works is attached to the offer is the default, the or is optional, And then once you check the box, the 3 is the default, unless you put in unless you fill in that, and then that becomes the amount or the number of days. And the reason why I'm going over this very basic format is because this carries through for all of the options, right? So every time you see the or and you see the number of days by default, or then you see an or with a blank, they all work the same way. That you can specify, you can paint by numbers here, and you can specify and get creative, but you get creative within their framework, right? They're saying, yeah, you got 3 options here, right? Don't reinvent the wheel, just use these 3 options. So that's the way this works for all cash, but it also it's a good representation of how this works throughout the document. Okay. So we're back to our RPA page 1. We're back down to the terms and conditions. So again, we're on page 1 here, the start of the matrix. We looked at the purchase price. The next item is the close of escrow date. I would say the second most important item. Everyone wants to know what the purchase price is of a contract. But the second most important thing, I think, is the close of escrow, because that sets the expectations, right? That's when are we going to close this agreement? And you can obviously specify here, you can say a certain number of days after acceptance, or you can put on a date certain, which is the or part. And by a date certain, you specify a specific date. Uh, most people I see, they do 30 days after acceptance, or 45 days after acceptance, or 60 days. They do something like that. I tend to like a date certain, though, because sometimes I think it's more important to pick a date, because oftentimes we'll see people do 30 days and they find out that 30 days, is Christmas or something, or it's Labor Day weekend or something. And there's often issues with something like that. So I like the idea of doing a date certain, but it's obviously up to you. The most important thing, though, is to work back from this date, right? Is once you establish the days, or how long the close of escrow is, that's when you should be working back from. Is to, can we realistically get this done during the time frame? Next thing is, I alluded to a little bit earlier, the expiration of offer. I don't see a lot of issues with this, but this is obviously, how long is your offer good for? You're making an offer here, and by default, it's 3 calendar days after all buyers sign, right? So we go to the signature dates. If there's 6 buyers for some reason, we go with the last signature, right? But what you're saying, how long is this offer open for? And so that's the default is 3, but sometimes you want to specify, you want to, play a little hardball and say, well, it's open until 5 p.m. tomorrow, right? Or 11 p.m. tomorrow night. So you can specify that in here. So that's something you obviously want to talk to your client about. The next item is how much are we putting down? And that's the initial deposit amount. Now, I want to differentiate this from what is the total down payment, because I still see people confuse that, right? So the initial deposit is typically between 1% and 3%. I rarely see it above 3%, and I'll tell you why in just a second. But it's typically between 1% and 3% of the purchase price, and that is really to secure the purchase, right? So to open escrow and to secure the purchase agreement, because some of you might not look at it this way, but essentially when you enter into this purchase agreement, the buyer has an option. They're essentially buying an option, right? They're giving consideration, which is this initial deposit amount. They're putting into escrow, and then they have an option to purchase, depending on if they can satisfy if the contingencies work for them, right? Even when you waive all contingencies, you still have some limited contingencies. And essentially what you have is you an option to purchase. Well, if I like this property and I do my investigations and I want to buy it, then I can purchase it at that time. So that's what the initial deposit secures. And the way they have this set up is you can put in a specific amount, or you can put in a percentage of the purchase price. And they want you to do it by default within 3 business days after acceptance by wire transfer or some other format. Typically, it's by wire. However, um, the reason why it's capped at 3% is, or I shouldn't say it's capped at 3%. That I rarely see more than that because that's the amount for liquidated damages. And when we get to liquidated damages, we'll talk about that in more detail. But most of you know who are doing transactions out there that it's typically between 1 and 3% that you put down here. Um, and now it's not the balance of the down payment. So if you're thinking, well, oh, I have to put 20% down on this transaction, or I have to put 10%, or maybe let's say I put 50% down on this transaction and I'm getting a loan for the rest. That's where the balance of that's 3F. That's not 3D1. That's 3F. So just know that that's the difference there. Um, Increased deposit. This is rarely used, but if for some reason you have an increased deposit at a later date, you use the DID form, which is very exciting, the DID form. And this is where you would put in your increased deposit. Um, I'm not going to talk about that in much detail because I rarely see it in the residential area. It's very common in commercial, however. But if you did, that's where you would put it in there. The next item is the loan amount. The loan amount, this I think this is important, mostly because it's important for financing, right? It's financing has become more important than ever because of the increase in interest rates and and prices being ever so high in San Diego that it's getting harder and harder for people to qualify for loans. And so I'm seeing more and more transactions fail because of loans, and not only fail, but have disputes because they thought they were going to get a loan, they didn't get a loan, or the loan was way too high. And so this 3E1, I think actually protects the buyer and the seller. It's one of the few. So I think it helps the seller. It doesn't necessarily protect the seller. Maybe that's the wrong way of saying it. It helps the seller evaluate the buyer, right? So if the buyer has very specific information in here, it helps them evaluate, in connection with their other offers of, is this person likely to complete this purchase, right? That's always something that you consider as the seller's agent is this buyer going to perform? Because there's nothing worse than getting into a transaction, getting 40 days into the transaction, and you take the property off the market and you're proceeding and you think you're going to close, and then someone exercises a loan contingency and says, oh, by the way, I'm not buying anymore. And you have to go to your seller and say, oh, seller, by the way, we have to go back on the market. And we just kind of wasted 40 days. It's also a huge waste of your time, by the way. I know that, obviously closing transactions is what you do, not putting property back on the market constantly. So I think this is important to look at in terms of, on the seller side, to evaluate the transaction. On the buy side, I think it's also important because, if you have specifications, if you're not dealing with a buyer has unlimited funds, and it's really important for them to get a loan, by all means, put in the information in here, because it helps with their loan contingency, right? That they're looking for this type of loan. Maybe it's conventional, maybe it's FHA, maybe it's VA. It's important, and you put it in there to create your loan contingency. Obviously, if you have seller financing, I'm going to highlight this one. Seller financing. I don't see it a lot on residential transactions. It's obviously much more common in land deals. But if you're doing seller financing, that's something I would always recommend. You talk to your client, and you'll hear me a couple times today say this. That's the type of issue that I wouldn't necessarily handle myself. I would certainly advise my client to obtain an attorney, or have an attorney look at the documentation, because there are a lot of pitfalls with seller financing. They're essentially entering into a long-term deal. You're not just selling it and walking away. Now you're becoming a lender, with all the pitfalls of that, and all the, there's rewards obviously in it too. But it's something I would certainly refer to an attorney if they were even considering doing seller financing, even for a short period of time. I often see it with some residential where there's some issue that comes up and they're like, oh, we're just going to give them a short-term loan for $100,000. And, sometimes I try to talk them out of it. Because there's a lot of issues that can occur there. But the point is that every transaction is different. There may be a really good reason to do it. Refer them to counsel. Next item here is occupancy type. What are we talking about? Is it primary as default? But you can obviously say a secondary or an investment property. That's important, obviously, for the lending aspect of it. But it's, that's the default here. So let's move on to the next page. Oh, there we go. Next page. So we finished page 1. Congratulations, everyone. We're part of the way through here. 17 pages to go, or 16 pages to go. I'm just kidding, but well, let's go to page 2. So when we start page 2, what we're looking at here is we continue on with the matrix, and we're still looking at the essentially finance terms, right? And so the first finance term is they want to know about is a seller credit. A seller credit, as many of you know, is whether the seller is going to give any type of credit up front to the buyer. I normally, and this isn't necessarily like a request for a repair or something that comes up during the transaction. This is kind of an upfront credit. I see this typically where the buyer and seller know about an issue, or they've been talking about something ahead of time, and so they know it up front. It's not normally something that two strangers that have never interacted before would include, but of course it's possible. The issue, of course, with the seller credit, references there 5E. If you go over to 5E, what the issue is that it has to be disclosed to the lender, right? And the lender may, they have certain requirements of whether it's going to be allowed or not. So I normally tell people, don't bother with seller credits. If there is an issue, you may want to reduce the purchase price rather than do a seller credit right off the bat. If you're doing something down the line, there's a different form for that. But if you want to get creative, this is the way to do it. Additional finance terms, you'll see that doesn't even have a number, but there's space here. This is not enough space to put anything real, right? This is kind of a catch-all. And the only thing you really should ever see in here is see addendum number 1 or see addendum number 2 or whatever the addendum is, because you really shouldn't, if you can write something in this one line here that is meaningful and actually isn't vague and ambiguous or something that no one's going to understand, more power to you. But most of the time, what I see, if there's some creative financing term, it's see addendum, and then the addendum has a much more drawn out information though. But that's where you would include it, and we'll talk about that. There's another section where there's a line for you to kind of write in something, but I would stay away from it to the extent that you can. Next item, the additional finance terms here. This one is near and dear to your heart. The seller agrees to pay the obligation of buyer to compensate buyer's broker under agreement. So what they're talking about here, this isn't new, obviously, but as many of you know, I think all of you know, let's be honest, that there's a lot going on with broker and agent compensation. It's really been the topic of the year ever since Halloween, when they came down with that ruling, and obviously the settlement and all the changes that are being made to buyer broker compensation. But if you want, this is important for you though, because if you want the seller to pay part of this or pay this obligation from the SPBB form, you're going to want to check this box, and then you're going to reference that form. Obviously, buyer, broker, and seller compensation is outside the scope of this discussion today, but this is a very important box, and this is a very important discussion. And I wanted to let you all know that there is a presentation coming up. It's a webinar on August 7th on the BRBC form. That's with Nancy Lane. It's on August 7th at 10 a.m. I would encourage you to put that in your calendars now. Don't miss it because that's critically important. How you get paid is the lifeblood of your industry, and your work. So please attend that seminar and educate yourself. It's great that you're here learning about this today, but also educate yourself on how to use those buyer broker compensation forms. It's going to be critically important for you to get paid on these transactions. Okay, next item is 3H1. This is that verification of all cash that we talked about. Remember, this has to do with timing, right? So now we're into timing issues. The same thing with the verification of down payment and closing costs. Again, this is timing issues, right? So they want to know, do you have the down payment and do you have the amount of money for the closing costs? Well, it's you're either attaching it to the offer or you're providing it within 3 days or blank of acceptance. So remember, that's how that works. Same thing with the verification of loan application. Have you made a loan application? And there's three types, and you can check the box here. So what you do is, okay, what do we have? Do we have a pre-qualification? Do we have a pre-approval? Or do we have a fully underwritten pre-approval? And those are three very different things, right? The pre-qualification is just, yeah, this person generally looks qualified, right? That's the kind of thing you could probably call up your mortgage broker and get fairly quickly. The pre-approval is a little bit higher level. That's this person is generally approved, but certainly I've seen in my context where people provide the pre-approval, but the pre-approval doesn't really mean they're approved. It's just that they have all the inklings of a potential approval. But the fully underwritten pre-approval is really the best, right? But that means that you've also done a lot of work with your mortgage broker, right? And so I would encourage your clients. I think an offer looks a lot better if you have a fully underwritten pre-approval, and it also makes the transaction a lot cleaner. So if to the extent that you can encourage your clients to do that, you hate to have them do work before you even have an offer, but this makes your transaction a lot smoother if you have that. And so whatever type of verification of loan application you have, if you're doing a loan, this is what you fill out. Next item is 3J. This is the final verification of condition. There's a lot of confusion about this section because if you go to paragraph 16 where this is discussed, they make it very clear that yes, you get to verify the condition of the property. You're supposed to go there 5 days or blank before COE, which is close of escrow. But they make it very clear in paragraph 16 that this is not a contingency of the transaction. And so I always get the question of, I went to the property right before closing and this, and this were there and they were supposed to be gone or this was supposed to be taken care of. What do I do? And again, each transaction is different as to what you do, but it could be a breach. It could be an issue that you handle, outside of escrow. It could be, it could be a major issue. It really depends, but it makes it very clear in this agreement. And, your clients should know this, that the final verification of condition is not a contingency. It doesn't create a new contingency in this transaction after you've waived the other contingencies. What it could entitle you to is some monetary damages or something like that, but it's not a contingency of closing. Um, Assignment request. This is kind of randomly thrown in here, and as you can kind of see, they put it randomly in here. The assignment request is actually fairly important in a lot of contexts. So the default on an assignment is if you're sending it to a trust, let's say, I'm buying the property and I decide to send it to my living trust. I can assign it kind of as a matter of right to my living trust as part of the transaction. But what about an assignment to someone else or an entity? Well, that requires a little bit more work. And so what they ask here is that the assignment request be done in 17 days or blank, because an assignment to someone else or an entity, you must get the consent to do that. Um, that consent can't be unreasonably withheld, which is, lawyer speak for, as long as it doesn't violate something else, or or they agree to be bound by the terms of the agreement with the assignment, it's generally okay. But I certainly have seen that with the case of flippers, or the case of shell buyers, where they try to come in, they try to put your property under contract, and then they try to sell it to somebody else. That I've seen disputes over that. And so one of the requirements in paragraph 23 is that if you're going to assign it to someone else, that you not only have to disclose the name of that assignee, but any compensation between the buyer and the assignee, right? Because that assignee, there could be some compensation going on there. If you're planning on doing that, obviously that's something you should be you should be looking for from the beginning of a transaction like this. If you're on the buy side and you're planning on assigning it to some entity later on. We often see, in the purchase and in the who's making the offers. Often it'll say Fred Pfister or assignee, right? So you're highlighting it right from the beginning that maybe I'm going to send this to my entity, right? Maybe I'm going to send this to somebody else, or I'm going to add some other party. But that's where the assignment request section is. Okay. So I want to highlight this. I'm jumping here to paragraph 18, and one of the reasons is to kind of highlight this issue of the buyer paying the compensation, because obviously compensation is critically important. And I wanted to highlight this sentence for you. If the seller agrees to pay the obligation of buyer to compensate buyer's broker, seller shall be entitled to a copy of the written portion of the compensation agreement between buyer and buyer's broker, identifying the compensation to be paid. Why am I highlighting this? Because if you're a seller and you're agreeing to pay the buyer, you're going to get a copy of that at least a portion of that compensation agreement, so that you verify that actually that's the agreement that they had, right? You don't want them to say, "Oh yeah, I want you to pay 2%," and then you find out that it's somehow different in the transaction, and that you're paying more. Um, because that's not the way this is supposed to work with the new compensation, right? You're not supposed to pay them more than the compensation. So I wanted to highlight that very briefly here. Okay, let's go back to I'm sorry. Let's go back to the matrix. Sorry, I did that one a little bit out of order, but I wanted to highlight that compensation issue because I know it's so critically important. And again, attend Let Nancy's webinar on uh, August 7th. Okay, RPA, we're still plugging along here. We're on page 2 of the RPA. We're talking about what I think is probably the most important part of the RPA, of the matrix, other than the purchase price and close of escrow. Those are the two most important. What's the next important item is contingencies, right? The number one thing, the number two thing, the number three thing, the number four thing that people get in disputes over the purchase agreement are contingencies. It's always contingencies. And the people don't understand them, particularly clients. You're dealing with people who have, it's their first, it might be their first transaction ever. It's the biggest transaction of their entire lives, right? And they're not experts on these contingencies. And they look at these and they're like, oh my gosh, there's nine contingencies right here, right off the bat, all with a potentially different time frame for when they can be released. Now they all say 17 on here, right? But they all can be modified, right? And oftentimes I do see them modified. And so when I talk to agents and brokers about filling out this form, what I don't see them often do is they don't go over these things one by one as part of the offer. They just say, okay, we'll make the offer. Here's the purchase price. Let's do the close of escrow time frame, and they kind of glance over. Are you going to get a loan? Okay, great. Let's do the. And they don't modify this. They don't talk to them about, well, maybe 17 days isn't enough time, right? Maybe we do need to get an appraisal. And so talking through these issues, you get a feel for, what the availability of these items, because there's a each one of these has its to me it has its own time frame. I rarely see someone be able to, unless they've started the process well before they get into contract. Getting a loan within 17 days is somewhat unrealistic, right? But that's when you have to release your loan contingencies. And how many calls have I gotten over the last 2 years where people say, well, they had a loan contingency, they waived their loan contingency, or they're beyond the time frame for the contingency, and oh, they're having a problem with their loan, right? Well, it's because their loan contingency wasn't long enough. So one of the things that obviously you might want to consider is is increasing this time frame. Again, it's 17 days for loan contingency, and you might want to increase that. Now, I'll say this: I think it's confusing when you have different time frames for different contingencies. And so, to the extent I can, when I'm doing commercial transactions or I'm doing residential transactions, I try to keep all the dates the same, right? And that's why I like the fact that they're all 17. But I also understand the concept that you'll sometimes you need more days. So it's really at your discretion. It's just making sure that you keep on the transaction, because there's nothing like what I see is the number one complaint I see from sellers is that they had all these contingencies, but we never sent them a notice to perform. That they just blew through these contingencies and we're out of contract. And I'll talk about that a little bit later. But keeping on these contingencies is one of the most critically important issues. But the way these work is a contingency in itself is these are ways that you can get out of the contract, right? Remember, I said from the beginning, or I said a little while ago, that when you enter into one of these contracts, you're essentially buying an option, right? You're putting down money. And you're not even really buying it yet. You're putting down some consideration, an initial deposit, for the right to buy the property. But that right is, you can cancel the transaction, you can terminate the transaction based upon certain contingencies. These are the main contingencies, right? So let's start with the first one, right? Loan is, can I get this loan, right? Well, I need a loan for this property. I don't have $2 million in cash. I need a loan. Can I get it? Now, people will check the no loan contingency because they want to make their offers sparkly and bright, right? They want to have the best offer because they want to get considered for this property. So I see people waiving the loan contingency. They're saying, I got cash, or I have enough money. I don't think it's going to be a problem. So they'll waive it. Think long and hard about doing that, because the next item is the appraisal, right? And the appraisal is different than the loan. A lot of people confuse the two, but an appraisal contingency is different than the loan contingency. Appraisal, but they're linked, because if let's say you do need a loan and the appraisal comes in really short, you got a $2 million house and the appraisal comes in at 1.8, the lender's not going to lend you on a $2 million home. They're going to lend you on a $1.8 million home, and they're going to want you to come up with the difference. That's a real problem if your client is strapped for cash. And so people will say, well, the loan came, or the appraisal came in at 1.8, I need, but I can't get the loan now, but I waived my loan contingency. Well, sorry, you waived your loan contingency. Unless you had an appraisal contingency and you had a minimum purchase price in here, then you can be out of luck. And so I see that often where people are trying to fudge the two, but know that those are different contingencies. Appraisal contingency is different than the loan contingency. Okay. Investigation of property. This is the classic one of, do I like the condition of the property, right? And that's your time frame to do it. This is, to some extent, I consider this like the get out of jail free card, because the investigation of the property is very subjective. It's, I looked at it again, I didn't like this or I didn't like that, and so the investigation of the property is, it's the more subjective of all these of all the contingencies here. It's somewhat subjective. So but know that that's what it is. That's your time frame, 17 days or blank after acceptance. The informational access to the property is kind of a strange one because you're like, well, how is that different than the investigation of the property? But essentially, what they're saying here is that this is the buyer's right to access the property, and it's not a contingency, and it doesn't create cancellation rights. I think they put it in here so that because some people waive their investigation right off the bat, but some people might still want to look at the property. They might want to review it. And so they put that in here as essentially a way to review, get informational access to the property, meaning they can look around, but it's not a real contingency. So I'm going to kind of breeze through that one because guess what? We have something brand new. Um, for any of you who live in San Diego, San Diego County, and have had their insurance canceled, here's one of them. Have your insurance canceled because you're in a wildfire zone. Guess what? We now have a new contingency, which is insurance. So this is brand new. You have your insurance contingency. Can you get insurance, or what does it look like? I've heard horror stories where people had a $3,000 policy, and all of a sudden, or the previous buyer had a $3,000 policy, and now it's 17,000. That might be material to you. So one of the things that every one of you guys are probably working on these days is as soon as your client gets into contract on a property, or even before that, they're talking to their insurance broker. Can I get insurance? And what does that insurance look like? Because some of it is really expensive nowadays. You have to be on the California unfair plan. Obviously, it's called the fair plan, but a lot of you think it's unfair. I do. But that's the new item in here is the insurance aspect. So know that that's a new contingency and something you should be talking about with your client, especially those of you who live and work in North County. Almost all of North County is a wildfire zone, a high risk, at least according to the insurance companies. And so insurance is more important than ever in terms of, and there's so many insurance companies that are leaving. So that's something that you should be aware of and should be looking at right away. Review of seller's documents. So uh, this is the once you get the seller's documents, like the TDS, or you get any other disclosures from the seller, this is how long you have to review it. So it's 17 days after acceptance or 5 days after delivery, whichever is later. So again, we're doing a calculation here, and this is something that you obviously want to inform your client of right away after you get acceptance. Okay, what are we calculating for the review of seller documents? Because those are really important. Now, some of you are using a TC, or maybe a lot of you are using a TC or some other software program that will calculate that for you. But make sure that that's front and center, and you're reviewing those documents right away, because that's obviously critically important. Preliminary title report. A lot of you, get the title report, and what I see is they just pass it on, and there's a lot of confusion about the title report. Now, please know that if you start reviewing it, the Field versus Century 21 case, which created the duties to go beyond the reasonable, diligent visual inspection, that obviously dealt with a title issue. And so if you're going to review the title report and you're going to opine about it, you're creating additional duties for yourself, but obviously this is their time frame. I often see what if you get what I call a gnarly title report, or something with a lot of exceptions, a lot of documents on it, it's often a good idea to refer that to tell your client, you may want to review that with a title counsel, title attorney, to determine whether, if it's important to them, what those things mean, because you'll often see all sorts of easements, all sorts of CC&Rs or things like that really have a legal effect on what they can or cannot do with the property, and that's something you really shouldn't be opining about. But this is the contingency period. So if you want to, if you know already that the property is going to have some issue there, this would be an opportunity to increase that time frame. Common interest disclosures. This is for your condos. Review of leased or liened items. And they give the example of solar panels or propane tanks. Obviously, these are the type of items that somebody else might own on the property. And so if you're going to assume that lease or that, or that lien there, then you certainly want some time to do it. Now, in addition here, you may look at this and say the contingency removed. Now you can remove all these contingencies, and I see it. I see people who remove these contingencies with the offer. Uh, not not really the best idea, but of course you're allowed to do it, right? And if you do it, you check this box and it should automatically populate that form if you're using zip forms and the software program. That's the way these things work on here, is when you check the box in the software program, it should automatically pop up that form. But that's the type of thing that I would have before I did a contingency removal of all these items, including title, things like that with my offer. I would have a long and hard conversation with my client, make sure that that's really what they want to do and that's in their best interest. Because if they can't justify it, then as bright and shiny as your offer may be, you may have problems down the line. Last item on here is the sale of buyer's property. Of course, that's a contingency that can have all sorts of issues. But a sale of the buyer's property, if they're trading in from one home to another home, it's not a contingency unless they check this box, the COP form, and then the COP form has a number of requirements for you to fill out. Obviously, your offer isn't nearly as good if you're filling out that form, because if you're on the sell side and you see a form where, okay, they have to sell their own property first and then get into my property, there's a lot of things that can go wrong there. So that's obviously not the most attractive offer, but there might be a really good reason why you want to do it. So if you do, that's how you do it. Okay. We're almost at the end of the matrix. We're getting there. The next section, and this is again on page 2, is we're getting down to M, which is the time of possession, right? When do I get the property? Well, the time of possession is typically upon the notice of recordation, right? So that's whenever you get the notice of recordation on the date specified. That's that's when you're supposed to turn over the property, or you could specify the date. So it gives you the opportunity to do that. And then it also talks about in 3M or attached TOPA, that's for a tenant occupied property. If there's a tenant occupied property, obviously you can get possession theoretically, but it's obviously subject to that tenancy if you're buying a property that happens to have a tenant. So just know the time of possession. This is that's when you can advise your client as when you're going to get the property. I normally don't see that edited. That's normally the default. If you do have a seller occupied or vacant unit, close of escrow, or this is so seller occupied or vacant units. What this means is the close of escrow date, the COE date. That's what that means. That's when you get the property. If the seller was living there, let's say you're just buying a home from a regular person and don't have anything that's out of the ordinary. It's on the close of escrow date. You close escrow, that's when you're going to get the property. However, oftentimes you'll see people say, well, the seller wants to stay. Personally, I think that's a bad idea, because I've seen a number of disputes where the seller doesn't leave when they're supposed to, or they try to bargain for more time, or they leave the property in a bad condition. For every one that goes well, I see 2 that go sideways, but it's possible you can do it. So I certainly see the bad ones, right? So you guys see probably the good ones. But there's 2 different forms that you can use, right? for if a seller is going to occupy the property after the close of escrow. And it really depends on whether they're going to be there short term or long term. And the way they define it, short term is less than 30 days, or I'm sorry, 29 days or fewer. And long term is 30 days or more. Because 30 days or more, California is treating that as essentially a tenancy rather than what the 29 days or fewer, which is essentially a license. Now, I'm not going to, this is kind of outside the scope of our discussion, but essentially, if they're saying they're 30 or more days, then they're essentially a tenant with tenant rights, which is where I see the problems, right? People say, oh, they're going to be there just until school starts, an extra 2 months, and then what if they don't leave, right? Then I got to do an eviction. Well, how long does that take? And so I'm not saying that you have to be experts on the law here. It's just this is the type of issue that if my client was if I'm an agent and my client is considering letting the seller stay there for 2 months until school starts or something like that, I'm telling them talk to an attorney. Talk to an attorney about what your rights may be, or what could be the pitfalls. What are the risks of doing this? Because if we're doing this, they might not leave. I might have to evict them. Maybe that's a breach of the contract. There's things that they should know that you shouldn't necessarily be opining about in terms of their legal rights on something like this. Next item here is the tenant occupied property addendum. This is obviously the if you have a tenant who's going to remain on the premises after the close of escrow, and this isn't necessarily the seller, right? This is a tenant. So this is, let's say you're buying an investment property or you're buying a property that has an existing tenant for some reason. This is the obviously the form you'd use. You'd use the TOPA. You check this box, and it should pop up the TOPA to work on that. Oh, sorry, I went too fast here. The last items here are N. Um, as you go down this document. So this is essentially the again time frames for certain things, and in terms of how long the seller has to deliver their documents, right? 7 days or blank after acceptance. The sign and return the escrow. The escrow holder always has their own instructions, right? How long do you have to return those? The time to pay fee for the HOA. I often don't see these things edited, but these are important deadlines that you should be considering with your client. Last one is the last one I do want to highlight evidence of representative authority. I really like what CAR has done with the representative authority documentation. They finally realized that people are buying these properties in sophisticated ways where they're representing other parties or there's entities involved, and it's not just buyer or the buyer is not always a single individual. So the evidence of representative authority of who you're buying it for, this document to be provided 3 days after acceptance. And you'll notice on something like this, they don't even allow you to edit it. So you've seen that a couple times in here, and you'll see it, as we go forward, that occasionally there's a spot where they just tell you what the time frame is. It's 3 days. There's no way to edit that unless, of course, you, for some reason, added it as an addendum or something like that. But by default, it is they just have a single date. Okay, we're continuing with the matrix. And sorry, I'm talking fast, but I want to make sure we get all this information in. I think this is an item that is rarely litigated. However, these are what I would call because I would call these the minor disputes. This is the items included and excluded. I don't see them litigated very often because let's be honest, how much is a stove, right? It's not enough to litigate over. But what I see it hurts agents financially and reputationally. And what do I mean by that? I mean that too many agents mess this up or put in the wrong information, or they have a disconnect with their client. I shouldn't say messed up. They have a disconnect with their client and they make concessions. I don't know how many agents I've seen who have bought a new refrigerator or a washer and dryer as a concession because they didn't have the right discussion about whether the washer or dryer was going to be included, and they're making a concession at the end, or they have an unhappy client, right? That's what I mean by reputationally, right? Sometimes this hits your pocketbook because there's some dispute over this and you try to make it right because you don't want that reputational risk, right? The reputational risk is you have an unhappy buyer or you have an unhappy seller who didn't realize, oh, the door screens or the window coverings were going to be included in the sale, and they think that they can take them, or they think that, oh my gosh, those things were going to be there, I didn't realize those were on the excluded items. And so I see a lot of what I would call minor disputes over these items. So that's my way of saying you should pay attention to this. Pay attention to this section. Don't just gloss over this. Often I see people just gloss over this and then they get in a dispute, halfway through the transaction, or worse, when they move in and they think, oh my gosh, you know, oftentimes it's like the curtains, the curtains or blinds are going to be there. And then they walk in and there's no curtains or blinds. And they're like, well, wait a second. Were those part of the sale or were they not part of the sale? Well, let's find out. So, uh, starting from P1 is what you're looking at. These items are included, right? Items included, all items specified in paragraph 9B are included, and the following if checked, right? So what that means is you got to go to 9B. Well, look what I did. I included 9B below here. And so what it says, these are the items by default, unless you affirmatively exclude them. These are the things that are part of the sale of the property. And it talks about all existing fixtures and fittings that are attached to the property. Now, fixtures are typically something that's essentially a legal term that is a fixture would be something that is attached to the property but isn't necessarily like the walls. It's typically things like a faucet, or it is like a door handles, things like that are essentially fixtures. Those are all included. But then item two to 9B2 is they talk about this. Well, the electrical. Well, you think that would be obvious, right? The mechanical lighting, but sometimes the ceiling fans. People may take the ceiling fans. So this is what I see most of the time. What I hear about is the window coverings. That seems to be the number one issue. Is that people take the blinds, the curtains, those types of things because, frankly, they're expensive. Um, or they take things, air conditioners. They take, these types of in-ground landscaping. They'll take out their favorite, tree or something like that. You see it. It's surprising sometimes, but you see it, right? So all these things are by default part of the property, unless you went into B2 and excluded them, right? Um, and but this is the op. So you could say, well, I'm going to take the attached floor coverings for some reason, and so then you would check the box in 9B2 and specifically exclude that, right? And if you didn't have enough space, you see there's only 3 boxes here. You could say see addendum, and you could do an addendum for additional if you're taking things that are in B not nine. I'm sorry, that are in 3P. I'm confusing myself. If you're taking things that are in 9B1 or 2 and you want to exclude them, you could put them in the addendum. But what are the ones that I'd say are most in dispute are these items that are part of the checkbox here on 3P1. These are the items: the stove, the refrigerator. These are kind of the big ticket items: the dryer, the dishwasher, these types of items. That if you want to include these, you check them, right? So if you want the video doorbell, if you want the Ring, doorbell, you need to include it, right? If you want the smart home control devices, you want to include it. So I think this is an important area to have that discussion once you've gone through the property and you see things that, wow, it'd be really nice to keep that security equipment. Some people might not care, or you really want that washer dryer, make sure to include it. Again, I see so many agents have to make concessions near the end of the transaction because they have an unhappy client who thought they were what they were getting and they didn't spend time on this section. One item I do want to highlight here um, is on 9B. If you use a stager, um, make sure that that you're making. If you look down here at the note at the end at the bottom here where it says this is 9B2. Note if seller does not intend to include any items specified as being included above because it's not owned by the seller, whether placed on the property by agent, stage, or other third party, the item should be listed as being excluded. So if you're using a stager, which I do see a lot on especially on the higher end transactions, and you'll see something that looks like it's beyond furniture. It's something that's like a wall covering or something that's a little bit out of the ordinary. Make sure that you're specifying that that's excluded if it falls within one of these items, specifically if there's something that's attached, um, or that could be considered a fixture or fitting. I do see disputes over that. So, oh, and 9B continues. So we only saw on the past page, we saw 9B1 and 2. Well, it continues here to additional items. So what are some of the additional items that are included by default? Security systems, right? So the security systems are included. Home automation, right? So if you have a smart home features, um, but I would specifically read these paragraphs, and if the home has those features, which more and more homes, especially the higher end homes, have, I would walk your client through that. Okay, do we want a security system? Do we want home automation? What does that mean, right? Is it part of the kitchen appliance, or is it some separate system, right? So that's what you really need to look at, um, is whether those are going to be included. And of course, down here at the bottom, I also want to highlight 9B6 for leased or liened items or systems. So those are not owned by those are items that may not be owned by the seller. And I always red flag those. For instance, if I ever see solar on the property, I always tell agents, and I used to do a class on it because there were so many disputes over solar. We're not getting nearly as many of those anymore. But it's always a red flag to me if I see solar, because I'm thinking, well, who owns that, right? What's the performance of that? That's to be questions that you should be asking right off the bat. So this is where that section kind of comes in of whether that's going to transfer with the property or whether it's not. Okay, we're back to the RPA, back to the matrix, and I'm going to go through some of these pretty quick because we do have other items to look at. This is we're getting to the end of the RPA. So here's your natural hazard disclosure. Oh, look, green arrow. That means this is a new item, right? The optional wildfire. Well, I should start by saying Q is where you allocate costs, right? So who's going to pay for what? Right? Well, who's going to pay? And the way this works is you specify who pays. So it's going to be the buyer, the seller, or both. Well, first of all, it's the natural hazard disclosure report. That's not very expensive. Optional wildfire. This is a brand new field for you to be aware of that you can get this optional wildfire disclosure report. If you want to get one, who's going to pay for it? Well, you specify. And you can even say who you want it provided by, right? If you're the buyer. This is also slightly new. The formatting is just slightly different. There's nothing, no different context. This is just mostly formatting. So you'll see that, and I've highlighted them in green just because I want you to be aware that these things have changed slightly, but it's really the formatting on these last couple of ones where these are additional reports you can buy, the escrow fee, they change. This is where you would specify who the escrow holder is. It's where you specify who the title company is. Again, these are slightly different in the new RPA, but this is mostly just formatting. Okay, we continue on in Q. Oh, sorry, I went too fast. These are the additional, okay, who's going to pay the county transfer tax, the city transfer taxes, the HOA fees, if there's a private transfer fee for whatever reason on this. And then you have these kind of miscellaneous set 16 and 17. These are miscellaneous fields where if there's some other type of fee or cost that can come in, you can just specify. Um, and if you have enough space in there. The one I would caution about is the other terms. And I do see this on, again, on transactions that have issues, is people add terms. And this is kind of an open-ended field. Remember I said before that, where there's not really enough space to put anything in here, and you should probably say see addendum. This is that spot. Uh, there's really not enough lines on 3 pages or 3 lines of single space typed to put any real terms that I would want to enforce. So most of the time, what you should be seeing in here is C addendum, and the C addendum should specify those terms, those additional terms that you're adding here. Now, I'll say this. This area is a huge area for disputes because people get too creative in here and they do not advise clients in writing to get counsel to review. I see a lot of agents and brokers, particularly agents, not necessarily brokers, but I see a lot of agents get creative here because their client wants something, right? Oh, we're going to do this, and they don't specify a time to do it, or they get too creative in here and they're not telling their client, oh, maybe you should get an attorney. We're altering the terms of an enforceable written real estate contract, and we're adding new terms that aren't on the form. Maybe I should get counsel for this, or at least I should advise my client to get counsel for this. Maybe they don't want to hire an attorney, but just my advising them protects me if I'm the agent. It certainly protects me to some extent that I've advised them that if it's important to them that they do it. But at the same time, I don't think you should be adding new terms to a form contract like this that are outside the scope of the contract without getting an attorney. Because really, what you're doing is you're practicing uh, you're basically practicing legal work and as an attorney. And I just went and I said I had an arbitration a couple weeks ago. I just went and through an entire arbitration where most of the dispute was over terms that were included in the other terms section that were arguably, to some extent, vague as at least according to the seller who was fighting over the transaction. The seller thought that they were vague, or uncertain, or that they meant something different than what the buyer thought they meant. And so that's kind of my point here, is not to throw anyone under the bus, but to say that you're often putting terms in here that are outside the scope of the contract, and these haven't been vetted by CAR, and so you're entering into a brand new contract. You better be right, or you better have the same interpretation of that as the seller, because you might have a dispute, and the dispute might ripen into a lawsuit, and that lawsuit might ripen into an arbitration that people spend a couple $100,000 to resolve. And so I don't want you to be on the bad end of that, and so I would be very hesitant to include other terms into a transaction like this, again, without getting counsel involved. So sorry, I'll get off my soapbox now, but be careful with 3R. Okay, we're moving on. I promise we'll get through all of this. The addenda, I talked about the addenda and advisories. There's a lot of them, right? And it really depends on your specific transaction as to which one you want to use. Certainly with 4A, the one I see most of the time is the TOPA, which is the tenant occupied property addendum. That's if you have renters. That's the one you're going to use. The other ones are very specific. If you have, manufactured home, or you have a, mixed use property, these are outside the scope of this today. But if you do know that you're buying one of those, you're buying something here, that's the document you want to check. And again, that should pop up the document for you to fill out that form. The other addenda section, though, is something I see used much more often. And this is, there's that addenda, right? That addendum number 1. This is where you would check, right? And you'd use that addendum form if you were going to use additional terms, or you're going to expand on something. But certainly things like a backup offer, a septic well, These are, or the intent to exchange. That really refers to a 1031 exchange if your client is doing something like that. Again, outside the scope of this today, but these are the addenda that you would use. In addition, this is also the section where you have the buyer seller advisories, right? And look at these. These ones are all checked, and I didn't touch these. These are all just checked by default. Um, and these are the buyer inspection, the wire fraud, the ones we all know and love, the fair housing, don't discriminate against people, the consumer privacy. But there's also additional ones like if you're using a trust, if this is an REO, or the wildfire disaster advisory. You can check these. Again, they'll attach to the agreement. Okay, so let's get into a couple of other areas. So the next part of this presentation will be on some items I want to highlight in the agreement, and then we'll hit the what's new. Okay. So what I want to highlight here is these are the statutory disclosures, right? Remember I said that the biggest issue for me in all these transactions are the contingencies and the disclosures. What does the seller disclose? What does the buyer uh, think about that, and do they release their contingencies? So what this section is, this is a really critically important section, is remember we talked about the in the matrix, say the contingencies. Well, this is what it references, right? Here's the statutory disclosures. We're talking about the ones you all know and love, the TDS, the NHD, SBQ, or the ESD. I hope you all know what these acronyms mean. And of course, the fire hardening, which is the FHDS form. So all of these are specified in here. Um, and this is where you would go in to say, well, okay, do we have to complete these, and what's the time frame to do it? The issue I want to focus on, though, is the delivery of adverse conditions materially affecting delivery of new adverse conditions materially affecting the property, or any material inaccuracy in these disclosures, right? Oh, sorry, I went too fast. So what I'm talking about is, okay, let's say you've provided the TDS, you provided that transfer disclosure statement, and you're representing the seller, and you have something that is material that has come up. Well, your obligation is to disclose that, right? So you have some new fact or new disclosure. And what I don't like on here is, you're supposed to, what should be happening is you're supposed to be doing an amendment to that TDS, or providing, okay, here's a new information. However, look at this bold paragraph in 11A4, sorry. The bold paragraph at the bottom here that says, however, a subsequent or amended disclosure shall not be required for conditions and material inaccuracies of which buyer is otherwise aware, or which which was discovered by buyer, or disclosed in reports or documents provided to or ordered or paid by buyer. So you're thinking, well, I don't need to update anything because the buyer is otherwise aware of it, or they discovered it, or it was disclosed in some report or documents that the buyer, they got they investigated the property and they got some report that includes it, the property inspection report, for instance. I think that's a risk, right? The risk is that you might think, well, the buyer is otherwise aware of this condition. I don't need to re-disclose it, even though it just popped up. But what are they aware of, right? There's always that issue of, and I know for those of you who have been to my red flags presentation, I talk about I had a client once, or in litigation, where they disclosed fill on property, right? Fill. What does fill mean? I don't know, right? Fill could mean dirt. That could mean rocks. Could it mean a satellite dish and old tires? Maybe, right? That's fill, right? Is it compacted, uncompacted? No, nobody knows, right? Can I build on top of that fill? Can I not? Well, my whole point is the buyer sued in that situation because it was old tires and a satellite dish and uncompacted, and they did build something over it, and that thing collapsed, right? And what did they say? Well, and the seller said, well, wait a second, we disclosed fill on the property. And what was the buyer saying? Well, you didn't disclose what kind of fill. If I had known it was a bunch of old tires, I never would have bought this property. right? And so you get in a dispute. And so my point is when you're looking at something like this, the buyer is otherwise aware. The buyer may have limited information, right? And a full disclosure is better than a misleading disclosure or a partial disclosure. And so I think that I don't like this paragraph very much. I think it gives a way for the seller to try to say, well, we disclosed it, right? Or you knew about it. But I think it's a little misleading because uh, you're going to always have that subjective argument from a buyer who says, "Well, I didn't know enough about it. I knew there was a little bit of fill, but I didn't know it was this. Or I heard about that there was a crack, but I didn't know that, you had done these things without permits. You know what I mean? So you're getting in a situation where, you know, disclosures a disclosure is better than a non-disclosure or a partial disclosure. So I just kind of wanted to highlight that section. Um, this isn't necessarily a new section, but important thing for you to look at and for you to know. Next item I want to talk about is the right to cancel. Again, I told you I was going to approach this from, okay, what are the types of disputes we see in the RPA? And so obviously one of the disputes I see is the seller right to cancel, right? Or the buyer's right to cancel. Um, you know, the cancellation is during a transaction, cancellations are the number one dispute. Do you have the right to cancel, or did they cancel correctly? And then obviously once escrow is closed, then did you disclose everything? Is this a non-disclosure case? So what I want to focus on right now is, since we already talked about the disclosure issue in our last slide, I want to talk about the right to cancel here. So the first item here is obviously the seller right to cancel, right? There's two people have a right to cancel. The seller has a right to cancel, and the buyer has a right to cancel. The seller has a right to cancel under a couple of grounds, right? There's not a lot, but the number one, and probably the thing I see the most, is that this buyer doesn't release their contingencies, right? If the buyer, and that's 14C1. If the buyer doesn't release their contingencies by the time frame specified, remember it was 17 days or blank for a lot of the contingencies, um, you to be on the spot with what you have to do next, right? Is a notice a buyer to perform. And that is in here, right? 14C1 says that if they don't remove their contingency by the time frame for the specified, then you should first deliver a notice of buyer to perform. Because a lot of people think, well, it's 17 days, they didn't release their contingency, I can cancel now, right? No, you can't cancel. You have to send them a buyer notice perform. And I see many times I hear sellers complain about agents because they didn't send a timely notice a buyer to perform, because they were trying to be nice and cooperative, right? It's their friend who is the other agent, or they called them up and gave them a sob story about they had something going on. Um, or even it is a sob story. Hey, I'm going to Cabo. Can we just have a few more days? And you give them a few more days, and guess what? They get back from Cabo and they still haven't released those contingencies. And then your seller's coming to you and saying, they were supposed to release contingencies on day 17. It is now day 32. What are we doing? Right. And then the seller's agent says, well, we got to do that buyer notice to perform. It's like, why didn't you do it on day 17? Right. And I know that people try to be nice, but I tell people don't do that. Deadlines are helpful. They force people to do what they're supposed to do. And there's always a possibility you work it out, right? There's always a possibility you send that notice to buyer perform, they jump, or they say, hey, I really need those extra days, and you can always agree with them to have extra days. But you've represented your client well. And that's my point, is you represented your client because that's what your client wants. So there's other ways to cancel as well, other than that. Failure to deposit funds, contact info from the lender, the verification of that all cash offer, the verification of the loan application, not cooperating with the GTO, which is the geographic targeting order, which actually applies to San Diego, or one of the few jurisdictions that applies, and the representative capacity form. But then there's also this kind of catch-all at the end that perform any additional buyer contractual obligations. People think that that's kind of like a get out of jail free card. Oh, I can cancel for any reason. That's fairly limited. I'd be hard pressed to even think off the top of my head of one of those that is a buyer contractual obligation that's not otherwise specified, but you do have that catch-all. Okay, buyer right to cancel. This is the main one you see. So this is the most of the time what I see isn't the seller canceling, it's the buyer canceling. And the buyer has, a general right to cancel. And the main one here is obviously the buyer contingencies, right? So if the buyer has not released a contingency, they may cancel this agreement. But notice this, and I'll highlight it here. It says, oh, sorry, it says they must cancel this agreement in a good faith exercise of any buyer contingency. Good faith. I've had many disputes over whether the exercise of the contingency was in good faith. And oftentimes, I hate to say it, it was the agents, it was I could contribute some of it to the agent because what they'll say is, well, we don't like we're canceling because we didn't get our loan. And then the seller thinks, well, wait a second, well, the buyer said they're canceling because they didn't get their loan. They had no loan contingency, or they had already waived their loan contingency. And then the buyer's agent will scramble, will be like, oh, it's because we didn't like the investigation of the property. We didn't like XYZ. And the question always comes up, well, was that in good faith? Right? Was it in good faith that you canceled because of the investigation of the property, but you told me, and you told me in writing that it was because of the loan, you don't have a loan contingency. I've seen disputes over that. Um, and my point is on this is that you don't obviously want to dispute, but what I also see a lot of agents do is they tell their client, "Oh, when we cancel this, we'll get our deposit back." No, actually, there's only two ways to get your deposit back. Remember that initial deposit you put down? The two ways are an agreement between the parties, meaning it's signed by the seller, or it's a court order. And so when you guarantee your client, oh, we'll just do this contingency and we'll get our deposit back. I wouldn't guarantee that. I've seen some sellers where the seller refuses, and it could be even bad faith refusal. And now there are consequences down the line for that, right? And there could be litigation over it or something like that. But my point is that it can be tied up for a very long period of time. And so I would never guarantee my buyer or my seller that, just because they exercise the contingency or they miss the contingency, that you're going to get that deposit, right? On the sell side, you might not get it all. On the buy side, you might not get it all. So be careful on your contingencies. It's the number one thing that I see in disputes during a transaction. Okay, so new terms. We have about 20 minutes left, and that's enough time to hit the new terms because the new terms aren't that long. Um, the new terms, the first one here is, and I apologize, it's hard to read in this, but I have the green arrow to point to it. We've now added a new condition to closing, that the seller is not responsible to repair any holes left from the removal of wall hangings. Car thinks of everything, and don't they think of everything. And I guess there were a number of disputes where people had holes in the wall, and people were, here in this litigious state of California, people were having disputes over it. So they now added that is a new item, that the seller is not responsible for any holes left by the picture on the wall. Okay, next item that's new, if you notice here, the insurance contingency, buyer's insurance contingency. Remember we talked about the new item in the matrix was buyer's insurance. It was a new contingency of the transaction. Well, it carries forward down into the meat of the contract, right? So on page 5 of this contract, in paragraph 8, now they're referencing the insurance contingency. And oh, by the way, here it is. This is a brand new section, 8D now. And what it says is this agreement is contingent upon buyer's assessment of the availability and the approval of the cost of any insurance policy desired under this agreement, right? So they could look for any type of insurance they want, and they have a full-blown insurance contingency. So for that, for whatever time frame was in 3L4. So that's the way that works. You look at 3L4, that's the time frame they have it. Whatever insurance they want to get during that time frame, they can try to get. If they don't like it or they can't get it, or if they, then they can say, well, I'm exercising contingency, I'm getting out of this transaction, or I'm going to try to get out of this transaction. So new term. Okay. New section here. This has to do with the balconies, exterior stairways, and other elevated elements. For those of you who are up on the new laws, you know that there is a new balcony law that has swept California. And there's a new form for this. It's the WBSA, the Wooden Balcony and Stairs Addendum. I never would have thought it, but here we are. And so what this applies for, so this whole section is new. What this applies for, it doesn't apply for every home, right? So this is your single family residence wouldn't apply for, but it applies for properties with 3 or more units, which has a balcony or deck, stairs, or other structure that's at least 6 feet off the ground, which is pretty much any of them, that is supported in whole or in part by wood, or has wood-based products involved in it. And a lot of homes, even though they might not look it, have wood somewhere. And so especially on balconies. So it applies to a lot of properties. So this is a new document that needs a new addendum that needs to be provided. By the way, the inspection has to be on this new law. The inspection has to be by January of 25, and it's every 6 years thereafter. So this is just another report you need to deliver to the buyer. And if there's a problem, they need to make repairs, right? And that's Health and Safety Code 17973. That if it pops up that this disclosure includes a problem, they may have to make changes or pay for it. So this is for those of you who are selling condos, which I know are a lot of you. That you need to be aware of this wooden balcony and stairs addendum. This is a brand new issue just in the agreement. So please familiarize yourself with that form and this new law. Okay. Additional, this is in 14B3. They added a new sentence to tell you the obvious. Sometimes the changes in from CAR are just to clarify the obvious. In this new sentence is that they're advising you not to remove contingencies related to review of documents until after the documents have been delivered. Imagine that. Don't release something you haven't reviewed yet. So really what they're talking about here is that buyers have been, especially when the market was really hot, they were releasing all their contingencies, and then they were getting a subsequent disclosure. And I think there was a lot of confusion about whether that created a contingency or not. And it actually did create a contingency. I'm not going to get into all the details here, but those of you who are familiar with a Civil Code 1102.3 know that the delivery of documents can create a statutory contingency of 5 days if they're delivered by electronic, which almost everything is these days, and where they have an opportunity to terminate the transaction. So what they're really trying to do here, I think, isn't to reiterate 1102.3. I think what they're trying to do is state the obvious. Buyer, don't do this. don't release contingencies of documents you haven't reviewed yet. Okay. Next item here is this is new. This part of the paragraph here, and I know it's a little buried, but what they're trying to say is that once you're this is a notice of buyer to seller to perform. Remember we were talking about those release of contingencies, right? That buyer seller to perform. What they're talking about here is that if you're after the close of escrow date, so let's say you had a date specified, if you're after close of escrow, they're saying that essentially you can send that demand to close even after if you're after that time frame. So it's except for They're talking about when to send the notice perform, but if you're after the close of escrow, you can just send the demand to close escrow. Again, I see a lot of confusion about this, and I get a lot of calls because I get that the classic is, we're out of contract, is what they call it, and the close of escrow has expired that's specified in the agreement. The buyer still hasn't released their contingencies yet. And what they're really talking about here is you could proceed directly to a demand to close. But again, the demand to close also has its own issues. And so that's why I'd say advise you to talk to your broker or talk to your counsel, because if you deliver the demand to close incorrectly, it's void, right? And it also has a time frame of, can you really close in that time frame? So my whole point here is that while they include this new sentence, anytime you're working with a demand to close after the expiration of the time frame, I would advise you to talk to your broker and your counsel about that. Second issue here is they're clarifying something that I think is important. If you're sending this notice perform, but it's for multiple items, and the notice shall be valid for all contingencies and contractual actions for which the delivery of the notice is within the time period permitted and void as to others. And so what essentially what this is doing is it's clarifying that if you send the notice perform and it is incorrect because it lists the wrong items or has the wrong time period, it can still be partially valid, right? And I know that's confusing, but what they're getting at is, just because I've seen people say this, well, you said, you demanded that we release these certain contingencies, but I already released those, so this whole thing is invalid, right? And so what they're saying here is, wait a second, that's not right. If you just because you said release all contingencies, but they already had released the contingency, doesn't mean this is otherwise invalid. So again, clarification from CAR. Thank you for doing that, CAR. Next item is has to do with compensation. This is in 19D. Is now that there's an obligation, again, new sentence here, the escrow holder, which is your escrow company, has the obligation to provide to buyer and seller a closing statement showing the amount of compensation being paid. So again, a lot of transparency around the compensation. You might say, well, we've always done that, but I think they're again clarifying to make sure that people know this, that there's not some outside agreement if people are paying. Okay, I'm going to move on here a little bit to hit these last couple items in the new section. This has to do in the this is in the term section of defined terms, and this is the concept of delivery. What they're doing is they're specifying when a document is considered delivered, because so many people don't, no one uses mail anymore, and very few people, do it. Everyone does electronically. I'll just put it out there. Pretty much everyone does electronically, and so they're trying to say when it's deemed in the possession of the other party. So I would reread this. This is just a note for you, and then also make sure to use this new DITA form, the delivery of electronic. It's to specify what address you want. I know a lot of your brokerages have a specified address where they send everything. Well, that's this new. Well, I don't think it's new, but they're really highlighting this DITA form of where to send all that information, and we'll look at that in just a second. Sorry, the Fair Appraisal Act notice. This is another new section here. This is just making sure that everyone knows that they have the right to a fair appraisal. I'm not going to go into that in detail. I don't think anyone's out here to discriminate, but this is just a reminder essentially for the buyer and the seller. Okay, so we're going more additional terms. I'll highlight these two. We're now almost at the end of the agreement. This is where the offer, they've added these two new sections, 33B, B4B, which is to correctly identify the buyer. Just some clarification, and then 33B5 is a situation where you can put in the full name of the entity. So many times I've seen over the years where the name of the entity is incorrect. And so, or the trust name is incorrect. So they're trying to put in allow you to put in that information. The, uh, I'll hit these items real quick. Here are on the real estate broker section. So a section you know and love. The disclosure obligation by buyer and seller of the amount of the compensation. So again, they're trying to do transparency in the how much the agents and brokers are being compensated. So what they're saying here is that that essentially each broker agrees to disclose to their seller or buyer client the amount of the CBC, so amount of the compensation. So again, a new obligation for you. Well, not really new, but now it's specified in writing that I think you'd always want to tell your respective client how much the compensation was, but now it's here in writing. Um, and the last two items here are the attached data. Those are new sections, so you can specify. I would do that, frankly, every time. You can see here that you can specify your email address, but you can also attach it if you have a special email address, like your TC or your brokerage has a special email address where all communications or all documents are supposed to be delivered, which I think is a really good idea, by the way. That's where you can include that. Okay, so we're done with the new sections, and I'm just going to hit the last in my last 5 minutes here. I'm just going to hit these last items, which are what I call the dispute resolution or the liquidated damages section, because I think they're important, and I definitely see disputes over them, and I also see people talking about them in a way that they're not going over them enough. The first one is the liquidated damages. And I remember I talked to you about earlier that the 3%. Well, this is really 3% of the purchase price. This is where it comes in. It's Civil Code 1675, which provides that a liquidated damage provision in a residential real estate contract is valid if the amount is not more than 3% of the purchase price. It's deemed valid, right? And you're thinking, well, what is liquidated damages? What liquidated damages are is it's a way for, and frankly, it's a way for attorneys to decide up front in the contract what our damages are going to be. Because the traditional way you calculate damages is that, okay, you breached the contract, right? I'm on one side, you on the other side, you breached it. Now I got to say, how much did it cost me that you breached the contract? Well, in a residential purchase agreement, it's difficult, right? I got to okay, what were my holding costs? What was my percentage of tax for the last month when you breached? What was my mortgage? What was my out-of-pocket costs? It gets complicated, right? You go down a rabbit hole of what did I spend extra? And it could be very time consuming to calculate it, very difficult to calculate it. And so they have this handy way of using what we call liquidated damages to say, well, we're just going to fix it at a certain amount. We're not going to go through the rigmarole of figuring out how much exactly to the exact number of what my damages were. We're just going to call it whatever that initial deposit was. And everyone's kind of agreed to that, right? Or have they? Well, they need to initial this form, right? They need to initial this section. And I would encourage you to initial it because I think I think it's good for both sides, right? Because on the buyer side, it can essentially limit their damages, right? It can essentially limit their damages to the amount of that deposit. Now there are ways to bust through it, but outside the scope of this, but generally that's what it limits it to. But on the sell side, it's also because now they don't have to prove their damages. So I would encourage both sides to sign this, but it's up to them, obviously. I see most of the time people doing this. Next item is the mediation. Now, most of you know how mediation works in these transactions, where if there is a post-closing dispute, what the parties have to mediate first before they initiate litigation. Except well, they have to do that if they want their attorney's fees. If they don't mediate first, they can waive their attorney's fees, which is right. These types of transactions, the attorney's fees could dwarf whatever the damages actually are. So it would be very unusual to waive that. There are exceptions, however, um, and the exceptions, there are exclusions to that, and they're probate, small claims, bankruptcy, um, unlawful detainer evictions, and foreclosure. But in most situations, people are mediating. However, you don't have to mediate. Please know that agents and brokers are not bound by this unless they agree to it in writing. And I see a mixed bag here. Sometimes you want to agree and want to go. Sometimes you want to stay as far away from that dispute as you possibly can. And so that's a situation where you want to talk to your broker, you want to talk to your counsel, and you determine whether that's, whether you want to go to that mediation. Okay, arbitration. And I promise we're at this is the last slide. So we're just about done here at 2 hours. The arbitration is the last one I want to talk about because this is, I think, is the number one issue with people providing legal advice. Is I often see, I either see agents just putting the DocuSign for their clients to sign this, or they're explaining to them what arbitration means, which is essentially practicing law without a license. And I know you're in kind of a tough spot because your clients want to know what this means. Should I engage in arbitration? But you don't want to give them that advice. But at the same time, you want to make sure they check all the boxes and you don't want them to miss something. So I see a lot of agents kind of throw up their hands, just tell them, hey, you got to initial this box, and don't tell them anything about it. And the problem with that, of course, is technically you just gave them legal advice because they may not want to arbitrate, right? Sometimes, I don't know how many times I've had a conversation with a seller or a buyer in a transaction, and I asked them if they checked the box to arbitrate, and 9 times out of 10 they have no idea if they did that. They don't remember. They had no discussion about it. We turn to the page and we're like, oh, we're in arbitration, or oh, we're not in arbitration, and it's a mystery to them, right? Now there's ways around this to help you guys, and one of the ways is obviously, there's a CAR quick guide on this. You can certainly talk to your, oh, sorry, I went too fast. There's certainly you can talk to your broker as to what your brokerage policy is on this, but generally what you're doing here is you want to give them enough information for them to make the decision. They need to make this decision. This isn't a decision you make. And when I say them, I mean the buyer or seller. Your client should be making this decision. You shouldn't be making the decision. And if push comes to shove, if it's important to them, refer to counsel, right? Um, because arbitration is, I call it kind of the private school of the litigation field. It could be a whole lot faster and a lot more efficient, but it's way more expensive, right? Because you have to pay for the arbitrator, and the arbitrator can be very expensive in addition to your attorneys, right? So the reasons, arbitration is just like litigation because you have to hire an attorney to represent you, or you normally do. You gather information about your case, you do that discovery, you present evidence to a third party, the decision is binding, so it can actually help the client. But of course, they don't have the same rights that they may have in court. Their appellate rights and their ability to challenge an adverse ruling are extremely limited. And the cost of arbitration is extremely high. And so it really depends on your client. And you're thinking, well, why are you telling me all this? Well, I'm telling you all this because this is something you probably shouldn't be advising your client on the pros and cons of arbitration. It should be the type of thing that you refer to your counsel or to your broker, because you're essentially giving them legal advice as to what their rights may be. And I know that 99 out of 100 transactions don't end up in arbitration or end up in any claims at all, right? Most transactions are smooth. You can go your entire career without encountering one of these. But it only takes one time for you to get that litigation therapy, and you'll have wished that you had something in writing where you said, hey, if this is important to you, you should, advise them to on counsel. So I'm not pushing for attorneys to get more legal fees. What I'm doing is trying to protect you from a claim that, oh, you not only did you not do what you were supposed to in this transaction, but then you breached your fiduciary duties, and you have liability to me because now I have to go to arbitration or something like that. Again, the point here is to avoid disputes, avoid claims, sell homes, and make money in this business, and give your clients the best representation you can. And with that, I'm done. I know I went 3 minutes over, it looks like, from the clock, but I hope this was a helpful presentation, and I hope you got something out of this. And please come to the additional presentations that either I do or North County does. It's again, a great organization, and you really learned something from a lot of these presentations. So thank you, everyone. I know I'm looking at the chat and I see the Q&A, and I'll take a quick look at those to see if we have a little bit more time. I'll see if I can answer those questions, but I wanted to give you my contact information. Here it is. If you have any questions, follow up, you want to refer one of your clients, maybe you are a client of mine, this is how you get a hold of me. There's my email, there's my phone, there's my website. Thank you, everyone. And like I said, I will. I know some of you are gonna check off. I'm gonna check out the chat now that I have a breath, and see some of the questions. And yes, it looks like some of the questions were, was this recorded? And yes, it is. It'll be on NSDC Realtors TV.com, which is a great site for you to get more information and to look at other seminars as well. Let's see. There are some questions. And I'll just take these as they come here. It looks like Sherry asked, do you put the name of the trust under buyer? So always a good question is, I hear people say, well, my trust bought this, or it's in the name of the trust. Well, technically it's not. So the way a trust works is it only works through the power of the trustee. So technically what it should say is Fred Pfister as trustee of whatever the trust name is. But oftentimes I do see people put it incorrectly, where they just put the name of the trust, but the trust actually doesn't purchase. So if you did, see the name of the trust in the purchase in the offeree, for instance, you're going to have to do a representative capacity document anyway. But you may want to just stop that from the beginning, because that this person is the trustee. So you technically should put Fred Pfister as trustee of whatever the trust is. So hopefully that answers your question. There's a question from Lucy that says, can I put seller of record? I'm not exactly sure what that refers to, but perhaps I'll just keep going on something here, because I'm not exactly sure what that refers to. I know she said that a lot earlier. Lynn says, G3, if MLS offers 3% to buyer broker and my BRBC is 2.5%, do I check this box? How do I receive the 3%? Well, if you can't get more than your BRBC, so you wouldn't be getting the 3% in that situation. You'd be getting the 2.5%. So that should be part of the next presentation, or all the presentations on the buyer broker agreements. So I would strongly encourage you all to attend at least one of those, if not multiple, so you can get multiple perspectives and really get up to speed on that, because that's going to be critically important. The whole game has changed on the buyer side of how you get compensated. So there was a question, is this the basic RPA class, not a class about what's new in the RPA? Are you using the form last updated on June? The latest form we've seen has a 7/24 date. Yes, I use the June form because the July form has very few updates on it. And so the June form is the one that's released in zip forms as currently. So because the 724 has very minor updates, I did use the June form. But the issues that that I identified as new to be on both are on both. So hopefully that clarifies the question from Carrie. Um, Sherry asks, what if the property is not in the same condition during investigation of the property? I think I addressed that issue. Um, and I think what Sherry is getting at is that if you go to the property and they've somehow damaged it, then yes, you have a dispute. That's the issue. I would be contacting your broker. I'd be contacting probably counsel. I guess it depends on how extensive it is, and so that's the type of issue that I would address there. Because remember, it's not that verification of property condition isn't a contingency, so it doesn't create a contingency of closing. What it does is it potentially creates a breach of the contract. I know it sounds like they're one and the same, but they're not really. And so I would certainly discuss that with your counsel or your broker. Um, Another question from Sherry. Sherry has lots of questions here. So she said, where do you ask the seller to pay off the solar? I believe that's on the solar form. I don't know off the top of my head, but I believe that's on the solar form where you specify that. Again, not part of this presentation, but that's where I believe it is, where that section is. Another question, the termite inspection report. I believe that is, you're right, it would be in Q3. I'd have to look back at Q3 again. I don't know if I remember, I don't remember off the top of my head, but I believe that's where you would specify if you're going to request a termite inspection. Either way, that Q section is the allocation of cost section. So that's where you would always, if you're going to ask the buyer or the seller to share or who's going to pay for what, you always do it in the Q section. That's where you put that in there. And then an anonymous attendee said, I see a lot of agents ask for termite clearance in paragraph 3R. Is that advisable? I don't think you really need it in there. I think you could put it in the Q section, but I don't think it's the end of the world if you say something like, well, you have to pay for it in Q, and then maybe in R you're going to say it has to be cleared, or you're creating essentially I don't know if the intent of that anonymous person was to say, well, this is a contingency now. I mean, certainly it would be it's part of the inspection. I mean, there's different ways. What I'm getting at is there's different ways to do it. I don't think R is wrong. I just have a strong feeling about R because I often see people just make up terms and they use like shorthand, or they create a new contingency in one sentence. And you've seen the CAR contract, it's 17 pages for a reason. It's not because people don't like to specify things specifically. We have the thing about wall hangs, for instance. Be specific, and generally specific means hire an attorney. There were some questions. Carrie said, would have liked some explanations about Q5 and Q6. Buyer agent checks these frequently and expects seller to agree. So Q5 and Q6, let's go back to those if we can. Uh-oh. I lost my screen share. Let's see here. Q5 and Q6. I just want to familiarize myself which one those were again. Q5 is the government required point of sale for inspections or remedial actions. I'm not sure what the exact question was on that, of why that there was like some discussion on that, but essentially what obviously I don't see that come up very often, but to the extent that you think a buyer or seller should pay for it, it's negotiable. like anything else. The only thing I don't like about that section is it seems like open-ended, right? It's, well, government required point of sale inspections. Well, what does that mean? You know, what does the corrective remedial actions mean? And it's a little bit of an unknown when you're entering into this transaction because it's not well discussed. However, you can go to 10B is where that section is, and you can read for yourself what type of documents should be in there and or what type of costs you're looking at. I just don't like open-ended costs. So frankly, I don't see that checked very often. But maybe the person who sent that in has seen that checked more often. Um, Looks like Sharon asked a question about what if HOA controls these decisions regarding balconies? Certainly, that's kind of the point, is that the HOA generally has the information there, and so the disclosure that you're providing on this generally references that. So that's why I would encourage you to look at that form. Obviously, it's a new form because most of the information is going to come from your HOA on that, and they often have control over it, not only inspection but repairs. And so you're kind of dealing with two issues. One is you're dealing with they should have done the inspection and provided the report, and then it's just, here you're just providing their information. But you might get caught in the situation of they haven't done their report, or they're in the process of doing the report, and then they come up with, oh, there's all sorts of problems with this, and we need to do remedial repairs. And so if you get on that unhappy situation where you're kind of stuck in the middle, that's when I think you're going to get in that situation where you're going to have to pay for some type of repair, or you're going to have to do something on the sales side that other than just providing them a form. The hope is that you're just providing them a form and saying, oh, this has been inspected and it passes, here you go, right? But if you get in the unlucky situation where you actually have to do something about it, that could be probably it's going to be a different negotiation. But that's really the uh, section here. So Jason asks, see if I can read this. In the case of a real estate license purchasing a property for themselves, would using 3G2 additional finance terms or 3R other terms be better? 2, how should the terms be worded to put the portion of compensation due to the real estate salesperson agent toward the settlement to the price of the property, instead taking their portion of compensation paid through the brokerage as a 1099? So that's there's obviously multiple parts of that question. I think I would go with I would advise you to talk to your broker or your counsel as to the best way to do that. I would generally see, however, to answer your question quickly, because it's obviously going to be complicated as how you do that. I think you would see that in doing that in the 3R. That one might be an appropriate section for the 3R. And I think I would word it that your any kind of payment, I'd make I would have I'd explain it in a paragraph of how you're getting paid for that, to avoid um yeah, I'm just going to go with that for the purposes of this presentation, that I think you should talk to counsel. And I think that would be a bigger explanation than just checking a box. You're going to be writing probably an explanation in the 3R. I don't know if you necessarily have to put it in 3R, but you have to. I would use an addendum for something like that. That would be a perfect opportunity to use an addendum with a well-crafted paragraph to say exactly what you're trying to accomplish and how it can be resolved. Looks like on page 2, can you please clarify 3A informational access is not a contingency? I think I discussed that, but essentially what they're saying is that, I mean, it says it right there that that's not a contingency. And the point is that you're permitted within that time frame to get information about the property, or at least I don't know a better way of saying it. I don't like that paragraph at all, but I don't think I have a better way of saying it than you're entitled to information about the property. Um, And I think I already expanded on solar and balcony disclosures. Sharon says, isn't the data information already included at the end of the RPA? Yes, as we saw, I think that her question was before we got to that section. Um, let's see, an anonymous person asked, can you confirm that the DLT form and S Corp would be exempt from issuing to anyone its tax ID number since S Corps don't get a 1099? I'm not sure why that question is in here with respect to the form, but um, I don't know how to answer that without getting into tax information. So I'm not gonna answer that question because one of the things we don't provide is we don't provide tax information, and I would strongly encourage you to go to your CPA for that. Um, Lenore asks, I understand that unless both parties initial arbitration clauses, it's null and void. Is that correct? The answer is yes. So the same thing with liquidated damages. Anytime you have two initials, if only one side, but the other side doesn't, it's not, there's no agreement on that issue. So those are good examples of, and I probably should have mentioned that if both sides have to initial, I just see people by default, they just initial everything because they think they have to. Um, let's see. Would you please clarify if the Justin said, would you please clarify if the arbitration should or should not be required for buyers and sellers to initial? It's a judgment call, Justin. I don't know if I can clarify whether it should or should not be required, because that's the whole point of the issue is that, and that's where you're practicing, you're you're practicing law without a license is when you're giving people, if you're recommending people that they do one or the other, that affects their legal rights to how they enforce this agreement or how they defend enforcement of this agreement. So it's really up to them. I normally see people check it. I'll just say that. I mean, most of the time I see people check it, and I think arbitration can be better for your client, but my gosh, it's expensive. And so your client um, may not be up for that. And it really depends on your client. Every client's different. I hate to say that. Every transaction is different. What might be good for the homeowner who's got a beach house in La Jolla or Del Mar is completely different than what the person who's buying a studio condo in Vista or wherever or San Diego. And so it's not a one size fits all. I'm sorry to say that. Um, and looks like the last question, it says, when buyer agent fills out seller name, if seller's agent has refused to give the name of the seller, can buyer's agent simply fill it in? Seller of record. And I think that had to refute that referred to the question earlier. If they refuse to give the name of the seller, that seems unusual to me because you could get the seller's name from the deed, who the seller of record is. So I assume that the buyer, yeah, I don't see why the buyer's agent couldn't simply fill in seller of record. But I mean, you have access, typically you'd have access to the deed. And so you would be able to fill it in that way. Or, I mean, that seems surprising to me that a seller wouldn't tell, or a seller's agent wouldn't tell you who the seller was because they have to be part of the transaction. But I guess anything's possible here. But with that, guys, I think I've answered all the questions. I'm more than happy to talk to you about this at a later date. Again, my information, let me just put it up there again so that you have it. Um, and let me see if I can get that back on there. Maybe not. Um, well, maybe not. Well, anyway, I hope you wrote down my name. Some reason it's not populating back up with the screen share, so I don't know exactly what's going on. But I thank you all for coming today. I hope you got a lot out of this. It's always my pleasure to to do these presentations and help out the association. So I'm glad you enjoyed it. If you did, if you didn't, just lie and say you did. But anyway, thank you guys so much for being here. Sell some real estate. Let's do it. Okay. Thank you, everyone.
Thanks, Fred.